Did you know banks can create money out of thin air? It sounds like fantasy, but it's true, and it affects your wallet every single day. If you've ever looked at your bank balance and wondered about the mysterious workings behind those numbers, stay with me as we uncover one of banking's most fascinating secrets. Let's clarify something important first. Banks are much more than just safe places to store your money. When you check your account balance, you're not seeing a pile of physical euros sitting in a vault with your name on it. What you're actually looking at are numbers in a digital ledger. This is a crucial point because most money in our economy isn't physical cash or coins at all. It exists primarily as these digital deposits. So how exactly do banks create money? It all comes down to something called fractional reserve banking, a system used by virtually all countries worldwide. Here's how it works. Banks are only required to keep a small percentage of your deposits in reserve. If I deposit 100 euros into my bank here in Italy, and the reserve requirement is 10%, the bank keeps just 10 euros and can lend out the remaining 90. When someone borrows that 90 euros and spends it, the recipient deposits that money in their own bank. That second bank also keeps 10%, 9 euros, and can lend out 81. This cycle continues, with each new loan becoming another deposit somewhere else. This process, called the money multiplier effect, significantly expands the money supply beyond the initial deposit. My original 100 euros still shows in my account, but the economy now has much more money circulating as a result of these loans. Every time a bank issues a new loan, they're essentially creating new money in the form of digital deposits. This isn't counterfeit money, it's a fundamental feature of our modern financial system. This process has profound impacts on our lives. It directly influences credit availability, which fuels everything from business investments to the mortgage on your home. It drives economic growth by enabling spending and creating jobs. However, too much money creation can lead to inflation, where too much money chases too few goods, driving up prices. Central banks, like the European Central Bank here in Italy, regulate this process by adjusting interest rates to either encourage lending when the economy needs stimulation or restrict it when inflation threatens. To recap, banks aren't just passive keepers of your money, they actively create it through lending. This seemingly magical process transforms deposits into new loans, digitally expanding the money supply through a regulated system. Understanding this concept helps make sense of everything from your personal finances to global economic trends. If you found this explanation surprising and insightful, please like this video, subscribe to our channel, and explore our other videos on economics and human behavior to deepen your understanding of how the world really works.